Well, hey there, everyone. Happy Wednesday, January 14th, and welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a actually quite beautiful, but kind of overcast, but not too rainy, Redmond, Washington. Hope you guys are all doing well wherever you're tuning in from. And thanks so much for watching my content here on the YouTube channel. Today, we're going to talk about, honestly, sort of a risk-off kind of day in a lot of ways. There were things that did just fine today, but I think those charts were overwhelmed by some of the leading names that struggle. Now, there was a nice afternoon rally that sort of alleviated what looked to be a fairly destructive day around lunchtime Eastern time. From there, we rallied higher, but the VIX moving higher, almost a full point, finished, was above 17 briefly, but finished just below 17. Got up to as high as 18. The NASDAQ underperforming the S&P. A bit of a risk-off move, particularly in the FAANG sectors, that rotation from value or from growth into value, that rotation from, that leadership rotation we've been talking about continuing to be very much there. So while breadth was good, which speaks to how lots of stocks did okay, it's the big names with the big weights that struggled. That weighed a lot on the NASDAQ and some of the other areas of the market. As usual, we will start with a quick recap of market conditions. We will look at some of the heat map and look at some of the leadership themes today. We'll finish off looking at some charts. I've hand selected a lot of charts. There's some days where I have to poke around and think about what charts to cover. This time, I probably had about 30 charts that I'd saved on the list. I had to cut it down to about 10 or 12 because I just felt like couldn't spend a whole hour going through charts here. So we'll get there in a minute. Before we get to the market recap, I do want to say a word of thanks in honor of Scott Adams. He is the unfortunately late author of the Dilbert comic strip, which I read so many times and loved how it made light of corporate environments and bosses and everything, but it did actually talk about technical analysis. He had a fantastic, strip on this that has been making the rounds with some of my peers in the industry. So thanks so much, Scott Adams, for some great laughs and entertainment over the years. Rest in peace, my friend. And thanks for mentioning technical analysis in your work for sure. All right, let's look at the major averages here. The S&P 500 down 0.5%. If a number of people have been asking if I'm warming up on the trumpet, not yet. These days, I feel like all I needed to do is talk about how close we are to 7,000, and that immediately repels the market. We draw down a little bit. So no performance today. The S&P finishing 0.5% lower. We're just below 69.27. So again, still very, very close to previous all-time highs. The NASDAQ composite underperforming, down a full percent today. The Dow ended up basically flat for the day. Earlier in the, around lunchtime Eastern, is down a lot more, just below 48,900. Nice rally in the afternoon, but still basically flat for the day. Small caps managing to go higher. And when you have this value over growth kind of day, when sectors like energy are doing okay, that's going to allow the small cap group to certainly generally outperform large cap. That's definitely what we found here. Mid caps were basically flat. Small caps up slightly. The S&P 600 was up 0.6%. The VIX was up to around 18. And in the first hour and a half of trading, it looked like the VIX was just on its way to going to perhaps even 20 today. Stalled out there as the S&P started to find its footing around 12 p.m. Eastern, and then rallied as stocks rallied in the afternoon. Volatility came off a bit. So the VIX did finish slightly below 17. But as you can see, that is above 16. And 16 is sort of our initial, signal. Anything above 20 is really the main signal we're looking for. But let's keep an eye on volatility. If we do see further deterioration, if we do see the S&P pushing further into the yellow light region, where it spent most of the day today, most likely we see volatility accelerate from here. Looking at interest rates, we can see the 10-year yield finished slightly lower. The 10-year yield's around 4.14. The long bond yield just below 4.8%. And so we have rates on the long end of the curve coming down. The TLT, which is a bond ETF that we like to track, up 0.6%. The dollar essentially flat for the day today. Looking at the commodity space, a super choppy day for the DBC. Gold, as you can see, was up 1%. Silver continuing to be just the juice in the commodity space. The SLV finished up another 7.6%. I mean, silver accelerating to the upside. By the way, most recent interview with the Market Misbehavior podcast, that should be ready for you tomorrow. I spoke with, trading legend, I would say, really an unknown market wizard, according to Jack Schwager, but a fantastic trader and thinker about mindset and risk versus reward in trading. Jason Shapiro, had a fantastic interview with him yesterday. He pointed out that the gold and silver trade really isn't crowded, according to his work with the Commitment of Traders report. I found that incredibly surprising. Felt to me like silver was a super crowded trade just based on the price action, but that's why the Commitment of Traders is so helpful. You can actually see not just anecdotally is it crowded, but is it actually crowded according to the positioning. I'll let him explain that a little bit further, but silver continuing to push to the upside. Now, the energy side, lower, particularly natural gas, the UNG was down almost 10% today. Big drawdown in that commodity ETF. Bitcoin has pushed well above 94 and 95,000, currently trading just above 97,000. I'm here to tell you I did take a position, and to be totally honest with you, I actually did have a small position in GBTC remaining. I thought I'd exited all of it, but in one of my accounts, I found it earlier today as I was going through and checking in. So apologies for a disclaimer that was not, or a disclosure that's not 100% accurate. It was as far as I knew, but I did have a small position at GBTC. I made it a less small position today with the move above 95,000. I think Bitcoin, certainly is more in a constructive environment, strong upside momentum. I'm happy to take a position betting on further upside, and we'll be very, very happy to unwind it if we go back down and break below probably like 90,000 or so. We'll look at the chart together. I'll show you why I felt a good time to add to that position, and so forth. Kind of mixed bag for the rest of the cryptocurrencies on the stock charts platform. Looking at the 11 S&P sectors, we can see 7 of them higher today, 4 of them lower. Energy, the big winner again today here. Crude oil prices popping a bit, but the energy sector really, rolling to the upside this week. I grabbed one of those ETFs. Might have been oil services. I feel like I grabbed for the list, but the XLE was up 2.3%. That is by far your top performer. Consumer staples number 2, up 1.4%. We'll take a look on the heat map, which stocks and groups did well today to propel that ETF higher. Real estate number 3, utilities number 4. So this is a second straight day where the market, hasn't been down a lot, but defensive sectors have been at the top of the list. And I think that is potentially a bit of a concern. The offense to defense ratio with the XLP toward the top and the XLY at the bottom, rotating down here, indicating a sort of a tactical risk off move. We'll see if that is a sustained move. But for now, I have to tell you that the 3 worst sectors are the 3 magnificent 7 sectors, basically. Consumer discretionary down 1.6%, technology down 1.2%, communication services down around 0.25%. Looking at the breadth conditions, pretty good today. So the markets were down not because a lot of stocks were down, it's because the wrong stocks were down, or the right stocks, depending on who you ask. The growthy stuff, right? The growthy sectors are a bigger weight in our benchmarks. Those mega cap names are mostly in the growth sectors. So you can't have a situation like this where the benchmarks are down, but the breadth is actually pretty good. On the New York Stock Exchange, 63% of those names were up. About the same for the S&P. On the small cap index, 65% higher. So generally pretty good breadth conditions here today. Worth noting, I don't, again, as I mentioned many times, I don't formally change my market trend model until Friday at the close. It's a weekly exercise. It's using weekly data. And one of my mentors, Jeff Weiss, who's at firm Jessup and Lamont, one of the oldest brokers in New York for many, many years, just a fantastic market technician and a genuinely nice guy, a consummate New Yorker through and through. He would tell me what happens during the week is noise. Wait for the weekly close. Wait for the monthly close. He taught me patience and not to get too excited about the day-to-day squiggles. I learned a lot from talking with Jeff over the years. And, so I'm pointing out the market trend model. While I don't update it formally during the week, I do keep an eye on what's happening. And the folks at Stock Charts awesomely created a widget on the dashboard so you can track. It updates just every day after the close. It checks the charts again and updates this little visualization. We can see here, short-term model bearish on the NASDAQ 100 as of today's close. And again, I don't change that formally until Friday's close, but something to keep an eye on. If we see further pullback, we could see the short-term models turning negative. That would obviously be a potential danger sign. All right, all the Magnificent Seven and friends in the red today. Now, the last couple days, we've seen kind of mixed, right? About half up, half down. That's been the story so far this week. Today, kind of everything lower. Now, Alphabet, which has been the strongest chart of this bucket for sure, basically flat for the day. Apple, which has been struggling, not down too much. But look at Broadcom, down 4.2%. A lot of pullbacks in the technology sector today, semiconductors and elsewhere. Meta, which has been on the struggle bus big time from a technical perspective, failing to get above Fibonacci resistance, down 2.5% today. Amazon, unfortunately, one of the biggest weights in the XLY, down 2.5%. Microsoft down 2.4%. Chart of Microsoft is challenging Meta for ugliest chart right now in terms of downside rotation. Netflix continuing lower, as has Tesla. So, you know, some of those leading growth names not looking particularly good right about now. All right, let's transition to talk about the heat map. As a reminder, we are posting this on our YouTube channel, and you are more than welcome and, in fact, encouraged and invited to drop a question in the comments section of our YouTube channel. Great to hear from you. We appreciate feedback on our show, on how I'm going about things. Always welcome, but we especially appreciate your questions. I've received so many great questions from all of you guys over the years. That helps me to think about where to focus my time and attention. It helps me to think about how to prioritize which markets we're looking at and how we're structuring the show in the months and years to come, but also gives us some great questions to reflect on for the Friday mailbag episode, which is coming up Friday of this week on the 16th. We'd love to answer one of your questions here on the show. So please take a moment and drop a question. Anything is fair game. Heat map, I mean, looks pretty good or pretty not good, depending on what sector you're looking at, right? This was not the S&P as a whole moving as one big thing, very much a differentiated day. And you can see technology, communication services, consumer discretionary. Those are your three FAANG sectors. And that's where I'm seeing the most kind of cluster of red. I would also say honorable mention for ugliness goes to the financial sector. And unfortunately, that's coming on the back of a lot of earnings this week. We highlighted, I think, JP Morgan on the show yesterday after earnings, but Bank of America, Citigroup, Wells Fargo, all having pretty rough days today. I think I grabbed Wells Fargo, I want to say, out of that group to share with you, but I grab charts during the day, and then I often forget which ones I've grabbed. I'm pretty sure that's the one I grabbed, though, to show that, kind of divergence, rotating lower. I mean, those are still good charts, not great charts, still good charts, but showing some weakness here. And I think the challenge for a lot of these names that have had really good runs is they need strong earnings this reporting cycle, which is this week, next week, the week after, basically, to justify further gains, right? A lot of things like financial stocks have had really good runs in the last quarter. Is that validated? Is that justified? Are continued sustained gains justifiable based on strong earnings momentum? And I think that's the question that, unfortunately, for a lot of financials, the answer is maybe not as they pull back post earnings. And again, these couple names are sort of the most recent examples of that. Let's talk a little bit about technology here. You know, generally speaking, except for like Intel, which made yet another new all-time high today, up 3%. A lot of these semiconductor stocks pulling back today. Lam Research, LRCX, pulling back. Now, this is fresh off a new all-time high, just in the last week, so it's not that bad yet, but definitely not powering higher. Broadcom is really at the lower end of a 3-month range, pretty close to making a new 3-month low, right? Which is a scan that I run regularly to look for stocks. I mean, I think NVIDIA is very similar to Broadcom, right? These are names that had been high flyers that, are just not great charts at the moment. They're kind of good at best, maybe more okay. It depends on what adjective you want to embrace. But Microsoft looking less and less like a leading name. This is looking like a lagging name. It did appear on the new 3-month lows chart today. So, I'm struggling to label Microsoft as anything but ugly, right? A primary downtrend of lower highs and lower lows. That's a fact. That's not a judgment call on whether I like the company or whatever. It's just a factual assessment of trend. The trend is down, right? And so I generally like things where the trend is not down. I want to find things that where the trend is higher. Where else can we look? Consumer staples, right? So I mentioned how they were at the top of the list. And again, in terms of movements today, maybe I highlight Philip Morris. I don't think I grabbed this chart, but this is what Philip Morris looks like, right? In May, June, July of last year, pretty good chart. And I think going into the June peak, we had this classic bearish momentum divergence on Philip Morris, higher highs in price, lower peaks in momentum. That was a great kind of leading indicator of a stalled out trend, right? A big multiple attempts to get above 180 all failed. Then we had the gap lower. I think that was on earnings in July, and then just kind of rotated lower from there. And then, pattern of lower highs and lower lows eventually broke below the 200-day moving average. Now, after the sort of Halloween low, we made a higher low in early December. All of a sudden, we're making a higher high. So look at what happened here, right? Downtrend, lower highs, lower lows, below the 50-day moving average. Look at all these failed tests to get above there, even here in November. And then finally, we make a higher high after a higher low. The momentum improves. We push above the 200-day moving average here in January, and the RSI finally getting to the overbought region for the first time since that June peak. The relative strength, which had been negative, right, had been underperforming June, July, August, September, October into November, now starting to outperform since Halloween of last year. So this is a stock that is, I think, rotated, right? It was in a distribution phase, a downtrend. It was in a consolidation phase, a sideways trend, and now I would argue clearly in an accumulation phase. We're above moving averages. The momentum is strong. The relative strength is improving. That speaks to a rotation, right? From a stock that is out of favor to a stock that is back in favor. And that's a tobacco company, right? I mean, that's a fairly defensive play. This is the kind of play that it's not thought of traditionally as offense. And that's what the stock looks like. Molson Coors, right? Beverages are the definition of defensive, right? The great Alan Shaw, the late Alan Shaw, who was the technical analyst at Smith Barney for a number of years, mentored fantastic technicians like Luis Yamada, Ron Dano, and others. He famously said, "When the going gets tough, the tough get eating, smoking, and drinking." It's this idea of looking at food companies, restaurants, beverages, alcohol, tobacco. These are the companies that tend to do well in a defensive tape because they're higher yielding, lower volatility, more defensive plays. Molson Coors Brewing Company, ticker TAP, new 3-month high today, breaking back above the 200-day moving average for the first time since early May of last year. So we're seeing a big rotation here, right? And we're seeing rotation away from the growth stocks, away from Microsoft and Apple. So where are assets going? Well, they've been in gold and silver. That's not new. Those things have been those outperformed the S&P for most of, if not the entirety of 2025. It's not rotating into non-US markets. Developed markets and emerging markets outperformed the S&P for most of 2025. So what's new? What's the emerging trends? It's in some defensive stocks, right? Consumer staples. That's where I'm seeing the juice here. Maybe one more as I'm just kind of randomly looking for kind of interesting breakouts. These are all stocks just breaking out a little bit. Church and Dwight, maybe a little early, right? It's sort of getting to a new swing high after finding support around 82 or so for the last 3 months. Finally making a new swing high, breaking above that December peak. Something like this, getting above the 200-day, like we saw with TAP, probably validates that uptrend. But these are some of the rotations, and what's consistent with all is the RSI is pushing above 60. Look, during this entire downtrend from March, April of last year, the RSI never got above 60, right? So one of the ways you can tell something's in a confirmed bearish phase is the RSI often gets oversold on those downswings, and the RSI doesn't get above 60 on rallies, right? So when counter trend rallies don't get above that 60 level, that tells you the entire momentum range is lower, right? The RSI is confirming that downtrend. So one of the things you look for a change of character is the RSI finally pushes above 60 on a rally. That tells you there's new demand. There's an influx of buying power. I think we're seeing that potentially on the chart of CHD. So a couple defensives. I might turn that into a separate YouTube video, maybe. Who knows? But interesting rotation. So impressive moves in defensive sectors. We talked about energy so far this week, so I don't want to hammer that much more. Although I did grab one of the energy ETFs to talk about. I would highlight within the healthcare sector. Keep an eye on Thermo Fisher Scientific, Merck, Johnny John, all making new 52-week highs today. So healthcare back in vogue in some ways. All right, we will continue on looking at some charts here together. Before we do that, I do want to remind you, recommended reading list. If you're looking for some books to read, if you're looking to upgrade your ability to incorporate some of the tools and techniques we talk about on this show, our recommended reading list is ready to go. That's on our website at marketmisbehavior.com. Just click on reading list at the top or scan the QR code that you see on your screen. I've got a number of books about the big three, the three that I recommend for everyone. Anytime someone says, I'm new to investing, what do I read? I recommend those 3 books. Then there's a bunch of other ones digging into behavioral finance, investor psychology and sentiment, personal development, which is something I'm super passionate about. No music books on there, but certainly books on creativity and living a more creative life. So I hope you can check that out again at marketmisbehavior.com. Click on reading list at the top of the screen. Great gifts for birthdays as well. All right, so interesting. Earlier in the day, I was like, ooh, we might actually finish the day in the yellow light segment using our traffic light technique. It wasn't to be. You'd probably call this a hammer candle because we go down a bit, we open, we trade lower, we close back higher. So while we did break below this trend line, I should update that so that it actually goes, so we can see where we're at going forward here. Let's see if I can do that. I think that's a pretty good way to do it. So I might spend a little more time fine tuning that a bit. But that's how the, we did trade below that trend line, potentially close below it, depending on where you draw that line. I would say we basically closed right at that trend line support. But this is taking the major lows from November and December, lines up with the early January low. It's pretty much where we were at today. We did trade below there. We did trade into the yellow light range below 6,900. We closed slightly above 6,900. So for now, I would say, support in question, but holding. We'll see Thursday and Friday if we get a violation and close below, get a follow through below that trend line support below back into our yellow light district. Above the green, in the green segment, what that tells me is basically the market conditions are strong. I want to be thinking risk on again on the tactical time frame. Yellow light, maybe caution, maybe be a little less aggressive about new longs, and in the red light area or the red light zone, I'd be thinking more defensively because that would be a new 3-month low. That would be breaking below key support in October and November. It's a long way below current levels. That's another 400 odd points below current levels. But in the short term, we're very, very close to indicating that this uptrend off of the November swing low may be over, and maybe we're in more of a back into this consolidation kind of sloppy, choppy sideways experience that we had in Q4. We'll see what happens. Now, as the market was noisily trading below our green light into the yellow light district, you can see that the volatility has continued to increase over the last couple of weeks. From the Christmas holiday to where we're at now in mid-January, the VIX has been generally trending higher. We finished today right just below 17. We did trade as high as 18 today. That's one of those classic red flags, right? When the market's in a pretty good uptrend, which I think it is, when the conditions generally seem technically strong, which I think they have, you look for leading indicators that tell you to be concerned. And some of those leading indicators would be things like bearish divergences. We obviously would look at breadth conditions, but two of my most valuable red flags that I've just found, it's not a great idea to be too bullish if either of these two things happen. Number one would be widening credit spreads, which tells you bond investors are getting nervous. Number two would be higher volatility, which tells you options traders are getting nervous. And we're seeing a little bit of that as the VIX has started to trend higher to start the year. Anything above 20 is where we want to start getting more concerned about a more meaningful decline. The last couple pushes above 20 in October and November ended up being tactical pullbacks before we resolved higher. But big downtrends have also started with the VIX pushing above 20 as well. So that's why we keep an eye on that. Something to watch as volatility is generally starting to push higher. I mentioned, sort of adding to a small position that I apparently had in GBTC. I have a number of different portfolios, and I missed one of those as I was reflecting or reviewing my holdings over the weekend. So apologies for that. However, I did add to that today, and I did that because of the breakout that we saw in Bitcoin yesterday. For me, pushing above 94,000 is an important rotation, because similar to what we saw back here, right? We were in a pullback phase. Then we broke above the swing high, and that ended up being the beginning of a big recovery. I still think the chart of Bitcoin has a lot more to prove, but breaking to a new swing high, momentum improving with the RSI pushing above 60 and now pushing above 70, that's enough for me to say, all right, I'll take an initial position on that breakout, just in case this is the beginning of a much further increase. And if so, I'll add to the position going on. But again, I think too often individual investors think in absolutes, right? When you see a breakout, it's like, I want to own 100% of my target position, or I want to own 0%. And it's like a yes or no. Do I own it or not? What you have to remember is you've got a lot more flexibility, right? If something's maybe bottoming out and you want to, just see if it's going to work, take a smaller position, take a partial position, right? Add to the position later if you're proven correct, right? So remember, you have a lot more opportunity to scale into or out of positions as things look kind of good or kind of bad. Too often, I think we go in absolutes, right? I own it or I don't. Remember, you can kind of own it and then kind of own more of it, and then eventually get to your target allocation. And I'm kind of in those early periods for something like Bitcoin. It's enough for me to take a position, but not enough to think, wow, this is the next greatest thing I'm going to observe. Offense to defense has been looking pretty good here over the last 6 weeks, but this week's starting to look less good. On the top panel, we have the cap-weighted version, consumer discretionary versus consumer staples. On the bottom panel, we have the equal-weighted version, consumer discretionary over consumer staples. Now, going into this week, breaking out, and we talked about how that equal-weighted version making a new 52-week high, pretty bullish, right? That tells you that offense is outperforming defense, things you want, doing better than things you need. This week, kind of rotating right back down, almost feels like a failed breakout as we rotate down a little bit. Still early days. I don't think it's a clear, downtrend just yet, right? The larger trend is still okay, but certainly a bit of a warning because that ratio has been so firmly positive. Now, why is that chart going down? Well, there are a number of things, but particularly the cap-weighted version definitely skewed toward Amazon, Tesla, both of those stocks pulling back this week. Amazon, I'm showing you here just because we're kind of making a new, we potentially have a failed breakout here. We highlighted this breakout above like 238, 239. That was the swing high from early December. We made these higher lows, and then we broke above that resistance. And then for the following week, kind of traded higher and higher. This week, we're actually rotating lower, and after making a swing high around 248, we're now sort of giving back some of those gains. With today, we're actually closing back below that breakout level. So with this kind of pattern, right, I don't always take a position. I don't have a position in Amazon right now, but when you have that breakout, I often use that breakout level as an initial stop, right? All right, as long as we hold that breakout level, that tells me that the chart is still doing what I think. What's happening this week is it tells me maybe this breakout wasn't a great breakout after all, right? And until we can get back above 240, I think this is a big question mark on the chart of Amazon. And when you take a big step back, you see this as a broader consolidation phase. We're still kind of mid-range of where we were back in November. It's not just Amazon. We've noted yesterday Microsoft trading below our support around 470 to 472. Today, following through after that breakdown, after that close below support today, making a new 3-month low. That's not a good look for Microsoft. The next downside objective using Fibonacci retracements would be around 423. But, again, the fact that we're not holding support, that means lower highs, lower lows. This period right here, this sideways period, the question was, which comes first? Do we break above 480, getting above the 50-day and indicating a new, multi-month high, or Do we fail to hold support? Do we break below 470? And that's what we're actually seeing this week. So continued risk off sort of vibe for Microsoft. And again, while there are other charts looking good, some of these big growthy names, that's one of the biggest weights in the technology sector, and it does not look particularly great. Shout out to my friends at the TSAA. That is a San Francisco-based community of technical analysts. I've been a member there for a number of years, and appreciate Nick Chong and the team doing a really good monthly meeting yesterday. Some great exchange of ideas, great exchange of charts. Two speakers, Rachel Dashel from Schwab, and Rachel did a fantastic job highlighting a number of charts. This is one of the charts that she profiled that I'll share with you here today. Classic head and shoulders top. I mean, I think future textbooks on technical analysis most likely should include this stock. I mean, it's not ideal, but it's pretty good. Now, is it the question I would ask you? Is it a confirmed head and shoulders top? Right? Is what you see on this chart enough to say yes, that is a confirmed head and shoulders top? The answer, unfortunately, is no, right? It is at this point, you have to call it a potential head and shoulders top. That's what Ralph Edwards and John McGee, author of what's called the Bible of Technical Analysis, stock trends, that's on the recommended reading list that I shared with you earlier at marketmisbehavior.com. Edwards and McGee laid out that when you have a pattern like this, it's a potential head and shoulders top until and unless we break below the neckline. So head and shoulders is you have a head. This almost has kind of two heads, so that's why it's not an ideal pattern, but clear left shoulder, clear right shoulder. There's not perfect symmetry, but pretty close. And the neckline is the line that you get when you connect the low between the head and the left shoulder and the low between the head and the right shoulder. So I'm just doing a horizontal line here for simplicity, but you can see that basically over the last week, we have bounced off of that neckline. So Dell below 115, I would say confirms a head and shoulders topping pattern, but it's not there yet. So I think at this point, you have to call it a potential head and shoulders top until it rotates lower. Now, undeniably, we've had a lower high. Undeniably, we're below the 200-day and the 50-day. That's not good, but breaking below 115 would indicate much further downside potential based on that peak. Also, a shout out to James Domino, a fellow CMT at SMB Capital, if I remember right, in New York. James did a great job highlighting some charts as well. One of the charts he brought up that I was digging into a little further today is Teradata, TDC. Now, I'm highlighting Teradata here because we have resistance at 32, right? We hit that in December, hit it again this week. So kind of a parallel peak, right? So a double top pattern, but look at the weakening momentum. So it's not a really good example of a bearish momentum divergence. That would be if we had higher highs on weaker momentum. But I'm just noting that, we're basically trying to make a new high and failing this week. Where the momentum, instead of being strong like it was in November and December, is more weak. So look at the pushes higher in November and December on stronger momentum. All of a sudden, we have a retest of the highs on weaker momentum. So it's definitely seeing a downtrend in RSI, which often can lead to a topping pattern. Now, on a chart like this, I would be looking at these swing lows in December. I'd be looking at that 50-day moving average. It's all around 29 and a quarter or so. I think breaking below that level would be a pretty negative breakdown. I'm writing that down so I can set that alert. I don't think I have that set just yet. Delta Airlines, while TDC not a perfect example of a bearish momentum divergence, I would say Delta definitely is. This is an earnings name this week. Higher highs in price from December into January. Weaker peaks in momentum. Today, kind of trading lower a little bit. This is after earnings yesterday. 50 days a little bit below current levels, around 66. But I would say the weakening momentum, the bearish momentum divergence indicates to me most likely the next move is lower as opposed to higher. Breaking below that 50-day, I think, would validate that short-term bearish thesis. But again, some names like Delta, which had been looking quite strong, starting to look a little bit weaker here in January. Wells Fargo is one of those financial stocks reporting earnings this week and not looking particularly good. We have a bit of a bearish momentum divergence there with higher prices on weaker momentum. But today, the RSI pushing just slightly below 40. Today, the stock closing below its 50-day moving average for the first time since November. Now, you have a bunch of pullbacks below the 50-day back here in the summer and fall of last year. Each one of those ended up resolving back higher. is this time different? We'll see what happens and if there are buyers that come in. But today, a downside gap, down a little over 5%, closed down about 4.6% today. Two more charts here. VanEck Oil Services ETF, ticker OIH, on my new 3-month highs list today for ETFs. The strength in oil prices, crude oil, I think has been questionable. However, the energy sector really lights out positive this week, and the OIH is probably one of the stronger energy ETFs that I can see there. It's stronger than the XLE, stronger than like the XOP, which is oil producers. This is oil services. Nice uptrend. And most recently, from a technical perspective, check out the gap above resistance. And when you have a gap above resistance, the question is, does that breakout level hold? And it did, right? A couple days after, we pull back to the breakout and then rotate higher, right? That's a classic technical pattern of a breakout, a pullback to retest that breakout level, and then buyers come in to push it even higher. I think oil services look pretty strong here. Final chart. Seattle-based company Starbucks. They make coffee. I don't know if you've heard of this company before, but strong chart on the new 3-month highs list today. And again, I mentioned that a number of times. New 3-month highs, new 3-month lows. That's something that I run all the time. I scan for that frequently. Whether or not I buy all those stocks, I would never honestly just buy stocks blindly because they're on the new 3-month highs list. But years ago, I would miss stocks that were breaking out. I would miss the next big uptrend. I remember missing Crocs when it rotates out. And so I dug in and thought, all right, what can I do to just make sure I don't miss that next good breakout? And I found, all right, I'm just going to start looking for the new 3-month highs list all the time. And I'm going to look at the new 3-month lows list, and I'm going to make sure that I don't miss stocks that are breaking out. And I'll also see things like oil services and pharmaceuticals and other stocks that have been in good uptrends for a while, but I'll also see sort of those initial breakout names. And when that list changes, that's when it's so helpful. Starbucks, sideways chart, a choppy consolidating chart. September, October, November, December. Today, I would say this week, rotating above $90, completing that rotation above the 200-day moving average. Coffee lovers rejoice. I think Starbucks at this point, a constructive chart until proven otherwise. As we like to say, innocent until proven guilty. That'll do it for today. Thank you so much for joining me here on Chart This with Dave Keller. Boy, it was so much fun to take time off during the holidays. I ended up taking about a 2-week break, 2.5-week break off of doing the show. I missed it so much. And last week was a little weird with the travel down to Florida. Super excited to be back in the home office this week. Fun to be back to doing the show, which I enjoy doing quite a bit. I hope you enjoy it as well. Please take a moment and drop a question in the comment section on our YouTube channel. Maybe we will feature it on the show on Friday. In the meantime, have a wonderful evening. I wish you the best. And remember, it's always a good time to own good charts. Take care, folks.